On the broadcast tonight, the wild ride in the financial markets around the world and on Wall Street.
Across the globe, there is fear of recession in the U.S.
People can't pay their mortgages, foreclosures coming down the road like bandits.
For America's financial giants, it's the worst period since the Great Depression.
The company just a few moments ago announcing that it is cutting its dividend by 30%.
In Shanghai, Bank of China shares were suspended amid concerns over its exposure to the American subprime lending crisis.
110 billion Australian dollars wiped off the value of our market in one day alone.
People could do nothing as the value of their shares plummeted.
The subprime slime, as we're calling it, taking more victims on Wall Street today.
We believe we've lost up to possibly $100 million between the two pension funds. We believe a lot of it is because of fraud, because of misleading lending practices, because of misstatements.
Some of these company executives knew that the subprime loans that they held were almost worthless.
The FBI says the cases involve allegations of fraud in various stages of mortgage securitization from those who bundle loans to the banks that ended up holding them.
This recession wasn't created on Main Street. It was manufactured on Wall Street. It was manufactured on Wall Street.
Wall Street took the risky debt, dressed it up as fancy securities, and sold them around the world as safe investments. A house of cards ripe with corruption, greed, and negligence.
Well, it's been a rough year on Wall Street, but investment bankers are still taking home bigger holiday bonuses this year.
Two of the fired CEOs responsible for some of the biggest losses rode into the sunset with some free money of their own.
What a travesty of a mockery of a sham.
Worst political scandal, Pat.
It is this subprime mortgage scandals and the guys at Citibank and Merrill Lynch losing hundreds of millions or billions of dollars and walking away with $200 million.
America's a great place to be an idiot CEO screwing up his or her company these days.
How do people get away with this? Where the heck is the SEC? What are they doing?
There was certainly some regulation that was missing.
There was no government involved.
These two parties have been complicit in allowing Wall Street and corporate America to literally have their way in the marketplace without regulation, without constraint, without responsibility, and without conscience.
Both the Democrats as well as the Republicans are on a jihad against investor interests.
So this week, Cleveland sued 21 of the nation's largest financial institutions for their involvement in packaging mortgages made by smaller lenders who the city argues knowingly lent to people who couldn't afford the loans. Tuesday, Baltimore filed a federal suit, and Connecticut and New York have begun separate investigations of Wall Street's role in the mortgage crisis.
The right of shareholders to bring private rights of action. Their right to protect themselves is a fundamental protection.
When you have a third party, whether it's a bank, a lawyer, or an accountant, that actually engages or orchestrates a fraud, that they should be liable. And if you don't hold those third parties liable, then what you have is you have people that can immunize themselves.
Welcome everybody to the last plenary of the first day. Happy St. Patrick's Day to all of you. We'll be celebrating after this session is over, but as a precursor, we decided we'd give you two Patricks for St. Patrick's Day. And some of you have met Patrick Daniels before. Last year when he was here, he took part in discussions about, and where he talked about British Petroleum, BP, and its very poor corporate behaviour, and suggested that something might well be done, particularly with British and European pension funds. And today you're going to hear a bit more about this when you hear Patrick Coughlin, who's the head of the firm, speaking to you. And it's a special welcome to him because this is the first time he's been to our conference. And as you note, the Coughlin firm is our diamond partner. That means, in other people's speak, our major sponsor. And we thank them very much for that. And we welcome now Patrick Coughlin the firm's chief trial counsel, who has been the lead counsel in numerous large security matters and was formerly an assistant United States attorney. So please welcome Patrick Coughlin.
So it's a pleasure to be here today. I thought when I was getting ready to come here, even several months ago, that we would know kind of what the fallout of the subprime meltdown, I heard somebody today call it an opportunity, but the subprime meltdown would be. And as I got up this morning to come over here, we had some shocking news last Friday that the Fed, for the first time really ever, had stepped in and saved a Wall Street bank. If you may remember the '98 meltdown with the Russian economy, that long-term capital was propped up. But it wasn't propped up by our federal government. It was propped up by the federal government getting a conglomeration of 12 banks together and getting a fund together to do that. Well, that's not what happened last Friday in the United States. So our fifth largest bank was propped up by the federal government, stepping in and taking a position for 28 days to give it a chance to be sold or partitioned. Today, it closed on Friday trading at $30 a share, down from $170 just 7 months before. So you have billions of dollars in market cap that was lost. You have over 100 million shares trading at $30 a share on Friday, and today that bank was sold for $2 a share. And the Fed backed up the sale, backing up $30 billion of impaired assets of that bank. So I don't think we've even seen near the bottom. And when that news hits our markets tomorrow, as it's hitting the Japanese markets today, we're going to certainly have some more rocking and rolling. And what I'm here to talk to you about is that the biggest funds in the United States have gotten involved in litigation and reviewing this situation. And I want to take you through some of the things that have happened in the United States. It's affected every part of our economy in the United States. And mostly, of course, the pension funds, whether they be public funds or private funds in that sector, but also municipalities. There's a credit crunch, and our housing market has literally been crushed. I've heard optimistic things, oh, this won't last long, it'll come back. I'll tell you, in January, we thought we had a week from hell. Well, we've had another couple of months from hell, and it's not over yet. And what's interesting is you take a look at the different players in this market. And one of the players were the bond insurers. These were traditionally bond insurers that insured municipal bonds, which were pretty safe because municipalities could always raise taxes. And so these bond insurers kept everybody happy with the AAA ratings and people could buy them. Well, they went out and started rating CDOs. Why? Because the bond insurers were paid sometimes 3-7 times the amounts that they were for municipals, but investors didn't necessarily know that because the rating agencies had given AAA rating. And of course, they were AAA rating with insurance. Well, you can just look at some of the stock prices of these bond insurers. But what's interesting, there are 7 top bond insurers in the world, and one's just moved here to Sydney and opened an office. But there are 2 bond insurers that didn't get near this market at all. Why and how did they stay away? And as we go through this presentation and we take a look at certain banks that stayed away or did the opposite of what other banks would do, I think we're going to have to ask ourselves a question about what did some people know and not tell others, and why did it happen the way it's happened across the board to us? A few months ago in November, we talked about a $300 billion write-off. And today I heard a presentation where it was $250, but you got a tax savings. And now it's at $500 billion because that slide presentation was a couple of months old. Well, I suggest today it's over $1 trillion in losses, and we're going to see that. How does it rank compared to our previous debt crisis? If we take a look at the tech bubble and we take a look at the savings and loan meltdown, this dwarfs any of those in the United States, and it's going to have a tremendous long-term effect on our economy. And even those with personal problems have seen that Wall Street's at blame here. And the question is, what were these CEOs who walked away with hundreds of millions of dollars as they walked out the door, as their companies literally crumbled behind them? What were they thinking? What were they doing? But the biggest question is, what was Bear Stearns, an 85-year-old firm that had survived the Depression, that had survived our Depression, which had survived World War II, and had different times had one of the most conservative approaches to investing in our country. What were they doing? What were they doing with other people's money? Now they're out of business. Foreclosures have hit an all-time high, and people are literally being put out on the streets as these rates, these improper mortgages were sold. Some were sold without any questions about, you know, what your salary was or what your debt was and things like that. But literally thousands of families that might have owned their house for 20, 30 years were sold products or sold mortgages, and now they're going out on the streets in the United States. And California is being hit the most. There are 20,000 teachers in California about to be laid off because of the subprime debt. Gasoline has hit $4 a share in California, and so goes California, so goes the rest of the country in the United States because they're 10% of the GNP. Goldman Sachs. What was Goldman Sachs doing? Goldman Sachs was selling some of these CDOs, packaging and securitizing and cubing and squaring these products, these mortgage-backed products, at the same time they were hedging. Goldman Sachs made money as everybody else melted down. It doesn't seem okay to go out and get a triple rating and then short it, even at the same time you're selling it to investors. And it's hit all over the country, whether it's China, Japan, the UK, and certainly Australia is feeling the impact of what was done in the United States. And what's happened in the United States is that the biggest fund, the New York State Teachers Fund, the Ohio pension funds, the biggest state funds, as well as the biggest Taft-Hartley funds, are taking action. It's not okay what the banks sold and what ended up in the pension funds, the retirement funds, you know, of the country. And the federal government is trying to keep up. You know, they did a $236 billion boost before. They've stepped in today. But I'll tell you, it's unprecedented and it's dangerous. Look at the estimates. The estimates from November to, and literally now these have changed, these have even gone up, to just last month. The estimates of what the debt, what the exposure was went from, for Citi, just under $10 billion to $24.1 billion, and now it's over $30 billion. And the same as for each of these big banks that were involved here. And what were the credit rating agencies doing? I mean, they went out and rated this stuff AAA. They didn't only rate it, but they helped structure it, even though they deny it. Evidence has come out in several recent cases in the United States that they actually structured the different tranches, especially the equity tranche, to make sure that you got the rating you wanted. They were again paid 3 to 7 times, and now they have literally downgraded thousands of these bonds that just months ago they rated. And they have a big disclaimer: you can't trust our ratings. But that's what every pension fund in the world does, is they trust those ratings and they bank what they could purchase on them. And a lot of the pension funds in the United States, they can't hold the debt after it goes down. So it's not a question of somebody saying, oh, there's unrealized gains in these. If a state pension fund has a certain amount of debt and it falls below a certain grade, they are, by their own bylaws, have to sell it. And so they're locking in their losses, literally, in the billions of dollars. And what were the CEOs walking away with? $161 million for O'Neill, $131 for Countrywide's Mozello. These were extravagant things. As their stock was going down and this was all tanking, Mozello was still selling tens of millions of dollars worth of his own stock. 32% of U.S. CEOs say they're overpaid. Well, I just would say, somebody said that now they tell us, and I would say literally 2/3 are still delusional. I want to talk a little bit about the Enron disaster. That was a case that my firm had and that I was going to try, and that I was the lead trial lawyer in that case. And I want to tell you how it worked in the United States, how the UC Regents, one of the largest, most prestigious university system in our country, with $80 billion under advisement, they lost $140 million in this case. And at the time they came to us, the issuer, Enron, was gone, and the accounting firm was vaporizing. And they said, we've got to do something here. This appears to be a huge fraud. And that's what's happening in our country, is that the different big funds are stepping forward at different times into different cases. Here it was the UC Regents that stepped in, and we went after the banks, and we so far have recovered $7.2 billion, with interest at $7.8 billion. We're about to distribute that, and a lot of that money is going to go literally unclaimed by funds around the world because they won't get in their claims. So we're just doing that right now. So if you have anything about Enron on your books, you can contact us and we'll help you get your claim in. But we're about to distribute that money with get the claims process hopefully done in the next couple of months and distribute it before the end of the year. What's happened in our country, though, is the SEC came out on our side in the Enron matter that we could go after secondary actors like banks when they acted in a primary way and they structured the transactions in Enron, as the banks have done here. And yet the Treasury Department, under the administration in the United States, came out against investors and actually had the government argue before the Supreme Court against us. And right now, the banks are rejoicing because they feel they have escaped liability. We're not done yet in that case, and we're still moving forward. As I said, we've recovered $7.2 billion, and it's up to $7.8 billion as we seek to distribute it. We represent a number of Australian funds, and they've gotten involved in different actions. We had an individual action as well as a class action in the AOL Time Warner, and while a class action would have returned $1.7 million to those funds, in the individual actions we were able to get them back $11 million. So it's a pretty good return, and people should consider in the big frauds getting involved. And that was our overall thing there. One of the other things that we do is derivative actions. The funds have been getting involved in the United States to change corporate governance. They don't think that the government regulation, has kept up to date. For example, just before this whole fiasco with the predatory lending or the lending that was involved and behind some of this, the banks knocked out some predatory lending regulation that was going to go through. We think the best way to get regulation in corporate America sometimes is through our derivative suits, and so do people like Bob Monks and others that help us in some of these cases. Right now we have a case against BAE Systems that spent a couple of $2 billion in the United States bribing Prince Bandar and to get certain defense contracts for England. And of course that hurt defense contractors around the world, from Australia to the United States and other countries also. And what did Bandar spend? Hundreds of millions of dollars on some of the nicest properties in the United States. He took that bribe money and spent it here and there. We were able to freeze these properties. And so we hope to affect some good corporate governance and do something with that, so this just can't go on without anybody saying something. The government didn't freeze these properties, but private litigation with funds stepping forward, a small municipality stepped forward to do this case in the United States. And of course we have the Chiquita banana fiasco, where Chiquita was funding literally death squads for several years that were killing union leaders, and Chiquita justified it that we had to protect our workers. I sat next to a CEO who said I would have done the same thing that Chiquita did. And I thought to myself, what are you thinking? And as I turned to him, then I did get a chance to speak, and I said I would do the same thing too. If I had 1,000 workers down there and I needed to protect them and get them out of harm or dangerous way, even if it took a couple of weeks. But that's not what Chiquita did. For years, they funded these death squads, for years for the protection. Well, what they did was they killed the union leaders, and they got protection all right, and what Chiquita did was profited off that. What if somebody funded a terror organization in this country for profit? I want to talk a little bit as I end this presentation about BP. Last year, Patrick Daniels, my partner, came and talked to you about a little bit about British Petroleum. At the time that was happening, we'd had a tremendous explosion in the United States. Workers' health and safety were jeopardized by BP. We had a tremendous environmental disaster up in Alaska. We had 15 workers killed down in Texas at this refinery where no work had been done to upgrade systems in years. And you know what BP, the biggest oil and gas company in our country, said to us is that we didn't have jurisdiction over them, that they could not be held accountable in the United States. Well, we got some London pension funds that brought a case against BP in the United States with an Alaska citizen, and we got jurisdiction over BP. And we also froze Mr. Brown certain of his compensations as he was trying to leave office with a pay package similar to what the big bank CEOs were doing in this case. And we got tremendous corporate governance in the year that we litigated that case, and it was going to the Alaska Supreme Court. And what we did was we got corporate governance that changed the matrix for their health, safety, and environmental things. It also tied, for the first time, their health, safety, and environment to their compensation package. And you know what else we did? We made sure that board members, and they didn't want to do this at all, had to visit the plants so that when they walked through, they would want to know that they're safe. So that's some of the things we do, and I'm happy to answer any questions about anything that anybody in the audience may have.